Hello and welcome to the How to Trade Like a Pro podcast. I'm Wieland Arlt. In this episode, I'm speaking with Dr. Tom Starke about his job as a hedge fund manager, where the differences between hedge fund management and retail trading are, and what quantitative analysis is all about. Before we start, please take a closer look to the risk disclaimer in the show notes. I'm here with Tom Starke, Dr. Tom Starke. Tom, you're in Sydney, or next to Sydney, you're in the Blue Mountains. I already visited you, and now I'm really happy to be back together with you in one virtual room just to discuss about trading, leverage, risk management, stop loss, and of course, trading at all. So welcome to my new podcast, Tom, and I'm happy to see you again.
Hey, thank you, Wieland, for inviting me. It's a real honor to be here. And I'm really looking forward to a great chat. I really hope the internet's gonna hold up this time. As we just discussed, we live in always staying in not very developed countries right now. So let's see how we go.
Yeah, I mean, in general, yeah, you're absolutely right. I mean, the more I travel, the more I ask myself, okay, what is this so-called third world again? Because I'm not so sure anymore, so because everything is pretty old, needs to be remodeled, stuff like that. And this is what I experience all the time. But of course, I mean, it's just a single view for myself. And well, every country, every first, second, or third world has its ups and downs, of course, as well. I'm pretty sure, right?
Yes. I mean, you're much more of a traveler than I am. I'm pretty much staying put here in this Greater Sydney area at the moment, and I really enjoy it. So I haven't really traveled since COVID, so just enjoying the beautiful nature here in the Blue Mountains.
But it's for a reason. A reason, and as you know, you're also a very passionate climber. You do climbings over there, therefore you're just in the perfect place, exactly for that, right?
Yes, correct. It gets me out of the house a bit, which is nice.
Yeah, but of course you also have to stay in the house. And now I want to just go over to, a little bit more into trading fashion. And as you mentioned, and I knew when I was there in October, you already told me, okay, and I have a new job. I'm working now. Of course, you're a hedge fund manager, but now you're working again as a hedge fund manager. That's not always the case. Sometimes you have some days or weeks or months off. So far, as I learned. And you're pretty excited about what you're doing. So please tell us a little bit more about your new position, what you're doing, and what you can learn from that.
So in this, I'm not the actual manager of the fund. I'm the senior quant guy there. So I'm developing the quantitative models for the investment strategies, and so it's always quite an operation. There's quite a lot of people involved in IT and so on. And my job is to develop models to trade, large sums of money, well over $1 billion, using quantitative models. So the operation is automated and fully systematic only. And I cannot do everything myself, obviously. So there is always a team of people that develop the connectivity to the markets and so on. And I built the mathematical and quantitative underlying trading systems, and I researched them and so on. And they're usually based on a large amount of different assets and strategies and so
on. How does it really work? I know from our last in-person meeting and when we were talking, and also a little bit just playing around with the algorithms, that it's not really something that the everyday trader does. Like retail trader usually do a little bit other way of doing some portfolio management or let's say trading systems. You you have, as far as I know and I remember, you use several systems just to put it into one, right?
Well, yes, the idea is effectively that you diversify as much as possible. So Harry Markowitz, I think it was, he was a Nobel Prize winner, and he was also the father of modern portfolio theory. And he said, diversification is the only free lunch in finance. And what that means is effectively that whatever you do in finance is you always pay a price for it. You know, if you increase your returns, you also increase your risk, and so on.
Yeah.
The only thing that is somehow that hasn't got much of a downside as such is if you diversify. So the more you diversify, you can actually increase or improve your performance overall without paying a price for that. I mean, that's not always strictly 100% true, and some people might object to that and say, yeah, but what about this? But I would say, by and large, this is actually the case. And diversification is not just using different underlying stocks, for example, but it's really diversifying not just in the assets you trade, but in the asset classes. So using different types of assets, for example, options, futures, stocks, then also different sectors. You can trade commodities, fixed income, again, equities, indices, foreign exchange, and so on. Then you can also diversify in terms of time frames. You can trade really fast trading strategies, much slower ones, and so on. And you can also diversify, of course, in the types of strategies you trade. So we may have whatever trend following, mean reverting, alternative database strategies in your portfolio. So that's actually quite a lot of diversification that you can do. And there's an interesting formula. Grinold and Kahn presented that in their book Active Portfolio Management, where basically the performance, the risk-adjusted performance that you can have as a manager is effectively your skill, which is one part of the formula, times the square root of breadth. And breadth is effectively how diversified you are. So as you increase your breadth or your level of diversification, that only increases your performance by the square root of what you add. But nevertheless, so for example, if you're not very skilled and you want to still perform well, what you can do is increase the breadth of your strategies that you use, or of your underlying assets, and you can do well. Whereas, for example, say Warren Buffett, he's incredibly smart and he only has a very small breadth, but he's got the smarts effectively, and it's also called the information coefficient. So the level of skill that you have is given by something called the information coefficient. And so this is an interesting formula that basically tells you where you can be at as a trader.
Yeah. I mean, you mentioned one very important point apart from Warren Buffett, because I'm a little bit critical about Warren Buffett. Not that he really achieved like something outstanding. That's the case. But usually a lot of people just feel like, oh, I want to be like Warren Buffett, which is of course understandable. But honestly speaking, I'm pretty sure that if you invest like Warren Buffett, you will not come to the same results, for the simple reason you don't have that lever. And the lever is, I'm very sure he has all the numbers of all the CEOs of all the companies right in his notebook. So whenever something goes wrong, he just calls the CEO and kicks ass, right? So this is what you definitely cannot do, right? As a private investor. I think that's one point. But apart from this, the idea of talking about portfolio or the diversification is especially something what really differs what you do on institutional professional, I mean, we are professionals, but you're institutional professional basis, from private investors being also professional. But usually people talk about different assets, different, sectors of economy, maybe also not just companies, but also, some other, maybe Forex as well, and something like this. But you are also talking, and especially you are talking about strategies to combine. So you're something like, like a fund which combines a lot of different approaches. And it also can mean that you can trade one asset in various time zones. Like, let's say you trade Forex, for example, you trade Forex on a weekly basis, on a 1 minute basis, and long and short at the same time. Is it like that?
Yes. The interesting thing is when you have a different strategy, or when you have, say, a strategy or different strategies that apply to the same underlying assets,
mm-hmm.
and you look at the performance, it's almost like you create a new asset. So if you say trade a specific strategy, let's say just some Forex pair, and you do it for various different strategies, and let's just assume these strategies are largely uncorrelated,
mm-hmm.
It's as if you would create new underlying or new assets or new products. So each of these strategies can also be seen to some extent as its own product. And that there's ETFs that trade different strategies in the market, that they're classified as products themselves. So
yeah.
And then let's say you apply the same strategy to various different underlying products. So you've got the number of the strategies you have times the number of products, and so suddenly the number of things you can trade increases a lot. What's important here is, though, and this is something that needs to be pointed out, is that whenever you talk about diversification, you have to make sure that whatever you diversify with is largely uncorrelated, or the correlations between these things are relatively low. Because if you have, say, two strategies that are essentially performing the same way, they look pretty much the same in terms of their returns, then you could just get rid of one. It's just like trading one strategy and times two. So that doesn't count. If you have different, or if you want to diversify, you have to make sure that your diversification is largely uncorrelated. And if that's not the case, then you're not really diversifying.
Yeah, true. I mean, just to make it just an example is like, let's say you're very happy about gold, so you buy gold physical, you trade gold future, and go into mining companies for gold, right? That really is the case.
I mean, that's exactly that's one of these things, But having said that, for example, there are trades, where you trade, say, a pair between, say, gold mining company and the gold ETF.
Yeah,
and that could be, that, or at least, Ernie Chan in his book, in one of his books, for example, he talks about this, where he does a pair trade between gold and a gold mining company. So that's definitely, an interesting aspect of trading using statistical arbitrage, or commonly known as pairs trading. Yeah. And obviously these things is like, like gold and gold miners or so, that they're quite correlated, but you could still trade them as a pair sometimes. I'm not sure if the gold miner trade still works, so I can't say that for sure. But this is a typical example of something that is still possible to trade. So when I talk about diversification, it's not it's not just that. It also depends on the types of strategies. Now, if you do a pair trade, gold versus gold miners, and you look at the performance, and let's assume it still works, which I haven't checked for years, then when you look at the outcome of that, so the actual pairs trading P&L, that would most likely be very uncorrelated to gold as well as gold miners. So that's interesting because, for example, you could trade gold miners separately, but then you could also trade the pairs trade, which is really quite uncorrelated, most likely to the underlying instruments. So the correlation coefficient would probably be far less than 0.3, I would say. Okay.
So what are you looking for when you combine a lot of strategies and correlations and, just to make sure that the combination of different strategies, timeframes, assets, and of course also directions really makes perfectly sense. And maybe also like trading frequency. I mean, there are strategies which trade every second, and there are strategies trading one time a year, something like that. So what are you looking for, and what are the measurements for you to really to say, okay, that's something I use in my portfolio, and that's something I just skip and you drop it?
Well, I mean, what you're looking for is an interesting one because, funny enough, a lot of it hinges on experience. It's actually quite difficult because there's a number of factors that you look for when you research strategies that make a strategy particularly interesting or not interesting. And it's not always, there is no clear-cut recipe for that, because that could vary depending on the frequency of your strategy, for example, or on the risk profile of your strategy and so on. So if you, for example, had a strategy that trades once a week, what you're looking for is most likely different than a strategy that trades once a second or so. So it takes a little bit of experience, or quite a bit of experience to get a feel for what you're looking for. But one thing that I want to point out, especially for the retail traders out there, when you look at the performance of a strategy, and this is what many people don't do, and what people should do. I've seen this a lot when I talk to retail traders. You should always assess the performance of your strategy against a benchmark. And the benchmark is usually, a buy and hold of the underlying assets. So if you, for example, trade the US market, US stocks, what you really want to do is you want to compare that to, say, a buy and hold strategy of the S&P 500 and see how it performs in comparison to that. Or if you trade Forex, you want to maybe compare it to the Euro USD pair or something like this. And it's really, really important to do that. It's really, really crucial that you make this comparison to a benchmark. And that's standard in asset management, but a lot of people in the retail world, they miss it. And if you don't do that, you can't really tell, is that strategy actually any good or not? You just see a line on a chart, but it doesn't mean much. And the other thing is, which is also important, don't just look at the return of the strategy. What you should really be more interested is the risk-adjusted return, or also called the Sharpe ratio. So that is a much better measure of whether a strategy is actually a good strategy or not. The return itself doesn't really tell you all that much. You should really focus on the return per unit of risk, or the Sharpe ratio, and that also helps you to compare different strategies with each other. So I think, in simple terms, that's probably what you should look for mostly.
Right. What are you looking for? I mean, what is your benchmark? So what do you try to beat on a regular basis?
Well, not really trying to beat anything, quite frankly. It's more, I use, for example, when let's just say I trade a basket of futures, then I as a benchmark, I just use a combination, an equal weighted portfolio of the underlying futures, buy and hold, as my benchmark. Let's just say it's really simple. And I just say, well, if I would take all the underlying assets and I buy and hold them, how would the performance look compared to what I'm my trading strategies?
Yeah.
And that's a sort of just gives me a good benchmark. And really, I mean, when you trade large portfolios, you're not expecting, like the crypto guys, 1,000% per year or so. That's just not achievable. So what you normally do is you go for a very modest, or often retail people, they think, oh, but actually achieving a return, say, of 15% a year, that's a good return when you work in a large asset management firm. I mean, if you have say $1 billion, 15% means you make $150 million per year. That's not too shabby. So yeah, you're not going for like huge returns, but what you're really looking for is how much return can I make per unit of risk. So I want to obviously reduce my risk as much as I possibly can, ideally zero, which is never achievable. And I want to get as much return per risk that I can. So that's the main aspect of my work is looking for returns per risk being as good as possible.
Yeah. I mean, thanks for sharing also like really profit expectations in terms of like, okay, 15%, you're already more or less outstanding, because this is quite a huge misconception in the eyes of retail traders, because they feel like, okay, if I have a performance of 10, 12, 15% a year, I'm still poor, feels like that. But you're amongst the best hedge fund managers and fund managers in the world, right? You're top class if you achieve this on a regular basis. But
yes,
given that, also, you're also, and you mentioned this already, just moving $1 billion around is of course a different situation than just playing around with, let's say, a couple of thousands or $100,000 or 200, whatever. Right, so you cannot move the way like a retail trader could do.
That's true. You've got, first of all, you got a lot more responsibility, and that's obviously a very, very important aspect of that. If I mean, if you lose your own money, that's not fun. But if you lose other people's money, that can be a lot more upsetting in some ways. So it's important to have that. On the other hand, of course, you have to live with the fact that you win, you lose on a regular basis. So, there's no way anyone can really achieve wins every day. I mean, having said that, if you're in the high frequency trading business, then a lot like these firms, they can achieve winning day almost every day. That's possible. But it's a different game and it's incredibly difficult technologically. And the other thing is it also cannot handle large volumes of money. So it's a very different game, which I'm not involved in currently. So if you're in a normal asset management firm, you win, you lose. That's just daily routine. But having said that, you got to be really, really mindful of how much risk you take with the trades, and then also when do you see that your strategy makes losses that are unexpected or abnormal. So there's a lot of statistics to be done on a regular basis on whether your strategy is still within the parameters of what you would expect, or maybe it already goes outside of these parameters, in which case you have to be careful. Now, is that applicable to retail traders? In some ways, yes, because even as a retail trader, you can achieve, or you can actually handle, or you can diversify. It's possible. It's just more difficult. It's more management and bookkeeping to do to be able to diversify. Obviously, it helps if you are able to systematically trade, to automate your trades to some extent. but it's definitely possible. And when I was still retail, I would definitely diversify quite a bit. And so you can do it. It's not as easy probably, but I know people that are in the retail space that are well able to do it. So
yeah. I mean, in general, talking about limitations and of course also responsibilities, I mean, that's very, very important also to understand that you cannot move the same way like you would do, like if you just manage your own money, because if you win or lose, it's still your money. And if you lose money, okay, you would go for another job or whatever. But if you lose people's money, different story for sure, right? So we of course cannot forget about this. But what I also like to point out is, and also maybe discuss, is that you're also limited with markets, right? So you're like sentenced to go for big markets, because when you load or upload on the market, or buy or sell, you really have to take care that you don't make your own prices with a billion. Saying that, I mean, you're not the only one with that problem, but that's quite a classic situation for institutional trading, right?
yes, of course. You do move the markets significantly when you trade large volumes. That there's no two ways around it. And the question is, or there's two things. The question is, first of all, how much do you move the market given a certain volume, or we call it participation rate. So how much do you actually move the market? And then the other thing is, if that is so, there is still the option to implement some more clever execution systems or algorithms that actually help you to achieve a reasonably good price without moving the market too much. So there is a whole other area of trading. Is called, a lot of people call this algorithmic trading, while they call the more the asset management side or the trading strategies as such more called systematic trading, whereas execution is actually the domain of the algorithms. And algorithms in execution are basically, thinking about how do I have to position myself on the bid-ask side, on the different price levels, in order to minimize the impact of my trade in the market and achieve as good a price as I possibly can. Now, for one individual trade, it almost looks like as if it was random, generally. But if you have hundreds or thousands of trades, you can actually see quite a distinct trend. It's a bit like, tossing a coin. If you toss a coin, it's like 50-50 if you get heads or tails. But if you do it a million times, you can clearly see a trend to 50% heads and 50% tails. And so if you build good execution algorithms in one trade, it doesn't really do anything. But over time, statistically, you can see that, for example, you can improve your execution by a few ticks or so. And if you trade large amounts of money, that those few ticks really can impact your performance quite significantly. And hence there's a big focus on those things.
Which sounds like it's a little bit more important how to execute trades than what kind of trades you do for a single, right?
It not necessarily, but definitely helps. So let's just say, as an example, you have each one of your trades has an expected return of, let's say, 15 basis points or 0.15%. Now, if you execute and your slippage is 5 basis points, so 0.05%, then that's already 1/3 of your P&L gone just by one trade. And if you do this both ways, in and out of the trade, then there's a huge amount of your P&L gone already, just like that. And so having a good execution makes a big difference in the profits you can make. So if you can reduce, say, from your slippage or your execution losses from 5 basis point to 1 basis point, then you immediately go from losing 10 basis points on your trade to 2 basis points on your trade, which is huge. It's 5 times less, and clearly that that really helps to improve your strategies massively.
True. I mean, it's the same trade, but different story, different outcome. And the other side of the coin is also were talking about a profit of, let's say, 15 points or pips. But if you make a loss of 50 pips, you still have like 10 pips on top of slippage, but you get just like 5 back as a profit. The equation doesn't work at all, right? So of course, this is something to work on.
Exactly, and if you can do this over time, every single trade, then of course that compounds as well, and obviously the outcome will be much better. Now it's interesting because some people don't really realize it, but a lot of brokers actually offer these execution algorithms, and I notice a lot of retail traders say, "Oh, what do you do with this stuff?" And they're not really aware of it. But if you actually have a look and you can see that your broker offers that, it can really be quite helpful to use those, or at least do a bit of research on them, because they can really save you quite a bit of money when you're trading.
Yeah.
Even for a small retail trader, that can really help.
Yeah, I mean, another point is that also especially small retail traders, we also suffer from fees, broker fees. Might be different if you're trading like really huge sums of money. Of course, you have a different basis as an institutional trader, but as a private trader, you're literally the ATM for everybody, right? So of course, you need to be aware of that as well, right?
That's very true. I mean, it's really important when you do this as a retail trader.
Yeah.
Like a lot, I see a lot of traders, they look at, which platform is the easiest to use.
True.
And that's a big mistake. Really, what you should look for is who has the lowest fees. And even if the platform is a bit clunky, I think that's just much preferable to then paying for the convenience with higher fees. Definitely.
Another thing you mentioned, and I really want to point this out as well, is profit taking. So also this might be a misconception. Of course, I don't know really what everybody out of the retail trading field really thinks about institutional trading, but I'm pretty sure it's something like, okay, they have the perfect entry, they ride the trend, you stay in the position forever, really, until your algorithm tells you, oh, now the journey is over, you have to get out. But now I listen and you're like, yeah, 50 points, I'm done. Is it that way?
Well, not really. I mean, obviously everyone also in institutional trading has their own philosophy.
Oh.
But what's interesting is when you do, and I've only recently put a little YouTube video out about this. Funny enough, when you
I linked this. By the way, I linked this in the show.
Okay, great. When you do an analysis of, let's just say you take a whole lot of strategies, maybe hundreds or thousands, and let's just say you use a strategy, you do a parameter sweep, and you look at the risk-adjusted returns of these strategies, and then you take, say, a profit take and a stop loss, and you apply like many different profit takes and stop losses to these strategies. Lots and lots of them. So you just basically do a statistical analysis of, thousands of strategies and thousands of different profit take and stop loss levels applied to these thousands of strategies. What you find is that only in a very, very small percentage of cases, stop losses and profit takes actually improve your performance. It's your risk-adjusted performance. So in the vast majority of cases, when you have just regular, say automated systematic trading strategies, applying stop losses and profit takes rarely ever improves your risk-adjusted performance. Now, I'm not saying, oh, don't do stop losses and profit takes. Everyone has their own philosophy. What I'm saying is that when you apply this, you have to be really careful, because quite often, when people say, oh, let your profits run, what they mean really is that, okay, we're letting the strategy go its natural course, rather than chopping it with a stop loss, or chopping it with a profit take.
Yeah.
You just let it go its course. And what you find is, in a lot of cases, you really have, statistically speaking, a better risk-adjusted performance of these strategies. So, of course, everything I say, you have to take it with a pinch of salt. This is my research. And of course, I'm more than happy, because I'm a scientist as well, and I've got a physics PhD. So I'm more than happy that you come along and just prove me wrong and say, hey, it's not true. And I can show you why it's not true. And I'm more than happy to look at this and accept it. So obviously, we always improve and we always learn in this space.
What you're saying is that literally it's like, okay, using stop loss is not that necessary, and it could also harm your strategy, right?
Well, harming is probably the wrong word. I would say it a little bit more in a sort of quantitative terms. It could degrade your risk-adjusted performance. Maybe that sounds a little bit more neutral here. Yeah. Harming is always probably not a good term. But at least from my research, I find that in a very small percentage of the cases that I have looked at, far less than 10%, it actually improves your risk-adjusted performance over the pure strategy without any stop losses or profit takes. So, of course, there might be classes of strategies where this is not the case, and so all these things that I say, they're not generalized statements. They're just results of research I've done. But there could be other cases where this is not necessarily true. But this is definitely a very strong trend statistically, and so it shouldn't be dismissed.
Yeah, I mean, I remember when we were together in your house and we were playing around with some algorithms, and we were testing some strategies, and turned out the strategy worked well without a stop loss. It didn't work that well with a stop loss. Of course, still I don't really want to believe that it's a good idea really to say, okay, maybe I just give it a bit too much room, because especially coming from the retail side, where a lot of people just go into a trade with a lever, like trading CFDs, Forex, but also futures, right? So what happens if I trade intraday and don't have a stop loss? Of course, there are several moves in the market which just go like, let's say, 2 or 3 points below the low, and then return back to the long side and to the trend. But also, and this might be the biggest concern, maybe also I have, I don't know, that once you leave the stop loss and go without, there is this one trade that drops down to the bottom and kills the account. But is this really the possibility, the trade, or are we just like too anxious about this? What do you think?
No, you're not too anxious. I'm generally anxious also from when I put my retail hat on. I'm anxious about using leverage in general.
Yeah,
leverage. And so again, it's not to say you shouldn't use leverage. Leverage can be extremely helpful. Yeah. But if you use a lot of leverage and then you think you can save yourself with putting in a stop loss, I would say, and I could say this quite confidently, that you're really mistaken in some ways. You got to be really, really careful with this, because you're almost always on a losing track if you have to do this. Now, leverage is a very interesting problem, and people have actually thought a lot about this and how much leverage in your strategy is actually acceptable. And there is a mathematical concept, you may have heard of it, it's called the Kelly formula, that discusses this. But if you're really interested in actually understanding a bit more about how much leverage you can or should use to make your strategy effective, there is a really good book, or Ralph Vince, who used to work with Larry Williams previously. He wrote a book on the mathematics of portfolio management, and he talks quite extensively about the amount of leverage you should be using, and he applies a lot of mathematical formulas to this. So let's just say you have a specific trading strategy, and you're not sure how much leverage you could apply. You can use some of Ralph Vince's models, for example, to calculate the leverage. Now, I have to say that there is actually a really interesting thing here, because on one hand, we have something like modern portfolio theory, or Markowitz portfolio management, for example, like simple, also called the mean variance portfolios. And they are, in some sense, designed for asset managers that want to keep their performance very steady and stable, which is what I'm mostly doing. Whereas Ralph Vince is a bit different. What he does is, he says, well, I've got a trading account. I want to just maximize my return no matter what, without getting wiped out, of course. And so what he does is he actually calculates what is the maximum risk he can take to increase his performance. And in his portfolios, you end up with huge swings up and down, with huge drawdowns, but overall you end up with a much higher return. So if you're an asset manager managing money for other people, you couldn't afford this, because that the phone would ring 24/7 if you did that. But if you're a small retail trader, you may well have a look at that, because if you have an account and you really want to just increase your profits, and you don't care how big the swings are, then something like Ralph Vince's models might just be the right thing for you. And what's interesting is, of course, he discusses this idea of leverage, because there is actually, when you trade a specific strategy, there is usually a very, very narrow window of opportunity or goodness in which you can actually play with the leverage. And if you make that window just a little bit too wide, and you just overstep it and just apply a tiny little bit too much leverage, that could really be your end. That could really wipe you out quite quickly. Whereas if you just stay below that, then you could really maximize your returns. And so it's important to be aware of that.
Yeah. I mean, speaking of Ralph Vince in the collaboration with Larry Williams, I'm not really sure where I heard this, but somebody and somehow I heard about this, that the cooperation of Ralph Vince and Larry Williams was more or less the main factor of the huge profits he made during the trading championship. Can you confirm this, or am I totally wrong? Not sure about it anyway.
Yeah, I cannot confirm this per se. I don't really know the story, but I heard that as well. I think I may have even read it in Ralph Vince's book. So yes, I think there is definitely some truth to it, and it makes a lot of sense, because interestingly, a lot of people think that it's the trading strategy and say the entries and exits that one uses to increase the performance. But in truth, what is actually a lot more important is the sizing of your positions. That is really what makes all the difference.
Yeah.
And if you have a great strategy, but you have poor position sizing, it won't be performing very well. But if you have a mediocre strategy and really excellent position sizing, you might end up with a much, much better strategy. So it's really important to remember that. And yes, I think that, I mean, I'm sure Larry Williams himself was probably an excellent trader as well. But yes, if you really want to pump up your performance, then
could be this outstanding performance over the years.
And of course, I'm not too familiar with all these with the sort of technical analyst traders. This is my area, but there's definitely something to be said for this type of trading where you focus a lot more on position sizing than most people do. And of course, I think a lot of people shy away from it because in their eyes it's probably a bit boring and it's probably also quite mathematical. So people go, oh, I can't do the maths and so on. But if you really grind your head into it, the maths is not that complicated, and it's just so helpful because if you do this sort of thing and you're interested in trading, you may as well really dive into all the different aspects of what it entails to be a successful trader. And anyone who is successful in this field will tell you that position sizing is just phenomenally important.
True. Especially in the long run, right? I mean, you can have a lucky punch, no problem. Of course you can do, but not in the long run, right? I mean,
exactly. You ultimately, it's all statistics, right? And yes, if someone tells me, oh, I made 100% this year, what does it mean? If you traded Bitcoin in the right periods, you could make thousands of percent, but you would have also lost a lot of it again. And it's not important. The important question is, over many years, what's your performance? And for sure, if you apply really tight and well thought through position sizing, then over longer periods, you will be far more successful than someone who doesn't really care about that.
Yeah. Let's return to your personal risk management, because if you put both things together, that is not so sure about the stop loss, but at the same time, when we feel like, I want to have the risk adjusted performance, this looks on the first view, it looks like, and it seems like that these things really don't fit together. But if you add position sizing to the equation, it makes a perfect fit, doesn't it?
Yes, I mean, position sizing is vital for these types of large scale systematic trading strategies, and this is really where a lot of the mathematics comes in. So we're getting quite sophisticated, and there's a lot of linear algebra to be solved when you deal with really good position sizing. Now what's interesting is, of course, if let's say you're a retail trader, there's this effect that no one can quite explain, that if you use equal weighted position sizing, in many cases it's not as good as a well thought through position sizing algorithm, but it can still actually give you a fairly good performance in comparison. So equal weighting should not be dismissed. It's actually generally quite, in many cases, it's quite a good, simple way of doing things. But as I said before, then if you want real performance, or say you don't care about your drawdowns and so on, and you just really want to increase your performance, then you may as well go with something more sophisticated and powerful. Now, as I said before, I don't personally use these things in my own work because investors or people, that you work for, they would be happy with these huge drawdowns. So we look more at a very steady performance, which minimizes drawdowns and generates consistent returns over time.
Right.
So there are different philosophies, and they're all valid. But the question is for oneself as a trader, or what is your investment objective? There's a big difference if you're, say, 25 or 30 years old and you've got 20 grand to spare, or if your trading is actually your life savings in your super fund. So the way you approach these two scenarios would be very, very different.
Yeah, absolutely. I mean, if you're young, you can afford being a little bit more aggressive from my point of view, because even though it's more risky, you have time to recover what you don't have if you're like more mature and senior and using your life savings, right?
Exactly. But being more aggressive and taking too much risk are two totally different things.
True.
I always, as you know, I'm a rock climber. I used to be a mountaineer, and I always remember a famous story of the Reinhold Messner, who was the first guy who climbed all 14 8,000-meter peaks in his lifetime. Yeah. And he said one of the and obviously he took quite a lot of risks, but he also said one of the reasons why he was actually the first is because more than anyone else, he would also turn around when he could see that things don't go anywhere. So a lot of the other mountaineers, they would still push and then perhaps die in the process. Whereas Messner, he said, well, okay, things don't look good, I turn around. And he turned, as much as he managed to do all the peaks before anyone else, he was also the one who turned around more than anyone else.
Yeah.
And that's actually a really interesting analogy, and it's really important here, taking risks and being suicidal are two totally different things. And
yeah, for sure. Yeah.
And
yeah.
I guess a lot of people struggle to see the difference. Like the YOLO crowd, you only live once. I mean, that's definitely probably a recipe for disaster in the long run. It may give you short-term returns, but but that doesn't mean you shouldn't take risks if they are reasonably well calculated.
True. Well, yeah, that's the point. Calculated risk. I mean, I'm a diver. I did shark diving recently. Today I did some not really cave dives, but still were like close, where there's some kind of cenotes here in Mexico, which is awesome. But still, it's like, okay, I know what I'm playing, and I need to know the game. So that's very, very important. Same like like rock climbing. If you're hanging somewhere and you feel like, I miscalculated something, that's good to know, but then you have a problem, right? And the same is if you're in the markets. But still, I will not let you go without really solving this puzzle because you already said, okay, Reinhold Messner, he also comes back, which is kind of stop loss too. So when do you exit a wrong position anyway? Do you exit it, or do you roll, or do you just hold forever? I mean, you cannot afford this as well, right? So what are you doing, and when do you pull the trigger in terms of, oh, I'm on the wrong road and I exit? When and why?
So in my own work, and you will probably be a bit surprised about this, but I don't have the notion of entries and exits at all. So when you actually look at the way my systems are trading, all you see is positions scaling up or down. So I've always got positions on in the instruments that I trade all the time.
Okay.
But based on the signals I get from what I call alphas, or in retail terms, the underlying strategies, they tell me how to scale up my positions or scale them down. So I've got signals come in from different strategies, if you will. And then I've got another piece of mathematics effectively telling me, it's like some scaling mathematics. And then that tells me how to scale my my positions in all the different instruments that I trade up and down. And so the notion of entry and exit, in a sense, doesn't really exist in my way of trading. The only thing I do is if it says, oh, okay, you got, I don't know, a position of X and you scale it down to Y, I use some sort of execution algorithm that then liquidates, I don't know, 5% or whatever of that particular position.
Mhm.
So that's, I think, interesting, and a lot of people will probably be surprised about this, but I do not have entries and exits, and so the idea of a stop loss shopping and anything isn't really there. All that ever happens is it says, okay, we add a little bit to this position, or we take a little bit away, or maybe we go net short from net long or something like this. But there is none of that, and the reason for that is simply because when my systems have lots and lots of different signals coming in, and a lot of times they will be the opposite direction. Some of them will say or buy, and the others will tell me sell, something like this. And so what that needs to happen is you manage all these signals through some whatever mathematical formulas or some machine learning, and then that spits out, okay, this is now based on all the underlying signals that come in. This is how you need to rescale your position on a particular day or particular hour or minute, and so on.
Yeah.
And so that way, the idea of a stop loss doesn't actually even really exist in that type of trading.
Yeah, okay, I see. And now everything gets perfectly clear because you adjust your position according to your risk management. It means if you are like in the profit, you adjust a bit. If you're in a loss, you adjust a bit. You buy, and you're always playing around with the same asset, and adjust the way you just need it without exiting at all, just giving parts away and getting parts back, right?
Correct. That's exactly it. And so that way, you get a consistent flow, so to speak. You trade the asset, and it actually makes sense, right? Why would you just go all in and then all out? The markets are not like that. They're like, a price, if you look at any stock price, it fluidly moves up and down.
Every price. Sure.
Yes.
Yeah.
And so why should your trading strategy just go all in and then chop it all in the next instant? It makes it from an intuitive perspective, you could say, well, actually, just scaling it up and down makes a lot more sense. But of course, there's good mathematical reasons for why this is true. But obviously, we're not here to discuss them too deeply.
Yeah, but I love the idea because this is exactly the point I wanted to go and to reach, to really make to show the difference between what we are raised as retail traders and what you are used to do, because it's a totally different way of thinking. As retail traders, like getting in, getting out, getting the profit, getting the loss, okay, and sum it up at like end of the week, months, quarter, year, whatever.
Mm-hmm.
But the other way around is totally perfect. Both are good, right? But they're totally different approaches. And I like both, actually.
Yes, they're very different approaches, but I would say that if you approach it more from a risk angle rather than a profit angle, in the long run, you're much better off. So if you're taking the long view of what you're doing, and in my opinion, that's what you should do. You should really take the long view.
Mm-hmm. Sure.
Then you're definitely always, from a statistical point, you're always better off if you focus more on risk than on return. And again, like it makes sense, because when you think about it, if you if you had a strategy and you can minimize your losses and you make a little bit of profit, that will just keep growing and keep growing. Whereas,
Yeah.
you don't minimize your losses and you can expect some huge losses at some point, then yes, all the growth is for nothing. It doesn't help. And so even if you take that simple thought experiment, that's already a great case to make for managing your risk properly.
Yeah, true. Great. Awesome insights, Tom. As a last question, and we already discussed this when we were talking in German as well. So it's like, what do you recommend somebody really try to or want to begin as a trader, no matter from what point of view, retail or institutional? So what is the starting point from your point of view? What do you think and what do you recommend?
It's a good question. Well, I think first of all, there's a few things. I think nowadays, if you're a retail trader, even, I would really recommend learning some programming. It's in my opinion vital, because you need to understand the nature of data and how to build strategies, how to test them, and so on. And if you don't know programming, then that's just incredibly difficult, and you just work on your quote unquote intuition. And unfortunately, intuition only works in the markets 50% of the time. So in other words, it's random. And so I think having you definitely get an edge if you have some understanding of programming. The other thing is, if you do know programming, one of the things that I always did, instead of using out of the box back testing engines and other things, I've actually always sat down and built pretty much all I needed myself. Now, I'm not saying you shouldn't use anything out of the box, but when you build all your own back tests, all your own systems from scratch, more or less, it really trains your mind to really think deeply about what you're doing. And it also helps you in the long run to understand what other people are doing. Let's say you then use a platform or someone else's system. You can already see from your own experience building your own stuff that what they're doing or what they're perhaps not doing. And that really helps you to improve a lot. And even to this day, I still always build my own systems, more or less, and I very rarely rely on third-party stuff. So I know it's a bit tedious and it's a lot of work, but it really helps doing things from scratch. And yes, maybe I'm a bit conservative here, but it served me well over time. So I mean, that's just my approach. And and then of course, constantly learn, keep learning, keep reading, keep improving. And I still do that. I live and breathe what I'm doing, and it's fun that way. I guess in some ways I've got sort of the dream job for many people, and the only way you can get there really is just by spending a lot of time and hard work, doing what you enjoy.
True. So true. Thank you so much, Tom. Again, it was an honor, a pleasure talking with you. Thank you for all the insights, also for really great conclusions for us, for trading success. And I'm happy to see and hear you again very soon. And therefore, all the best to you. Thanks again, Tom.
Thank you so much, Wieland. It was a pleasure to talk with you. It's nice to share this, and good luck to everyone who's listening, and all the best in your trading.
That's already it, and I really hope that you enjoyed this episode and you took away some learnings for your personal trading. If you want to learn more about me, about my interview partners, if you want to have a one-on-one coaching or even get into a training course with me or my interview partners, just get into the show notes and follow one of all these links you find there, and then I will be happy to hear and see you again. Your Wieland Arlt.